Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 84. On today's episode, we're going to talk about the busy week of earnings we had this past week. We had a Fed meeting, and we'll discuss what happened in that Fed meeting. We'll talk about the repercussions for the market, and we'll also discuss future value. How do you start looking at the future value of a company? Because that's what investing is, right? So we want to be able to say, okay, if I invest in this company, how can I look at the future value of that company? And how can I really get my mind around what that company is going to be able to earn in the future? And how does that impact the stock price? So get your mind right. And let's get to work. All right. Well, welcome back to the show, everybody. Appreciate you joining me once again. Had a busy week in the stock market, and so let's go over that. Also, if I sound a little off on the audio, it's because for the first time, nobody asked for it, but we're bringing it to you. We're actually filming this episode, trying out some different video recordings for this episode. So we will see how this goes, so to speak. So busy week in the market this past week, lots of activity, lots of just a lot of moving pieces. This is one of those weeks where not every week in the stock market is busy. This is one of those weeks where it was very busy. And so I want to start with the Fed meeting. So Jerome Powell did what everybody expected him to do, which was raise the interest rate 25 basis points. And so the market expected that. The commentary, though, was a little bit better. For the first time ever, Jerome Powell said that you could start seeing that disinflation has started to happen. He acknowledged that and said that, that we are seeing some signs of disinflation, even though it's very early on in that process. And so, that was all the market needed to hear. The market takes that, they look out into the future and say, okay, we might only need one more rate hike, and then the rate hikes will stop. And so we'll be kind of at this level somewhere, maybe around 5% interest rates, maybe a little bit below. We'll see where it kind of pans out, but it has an impact on everything. So you even look at like mortgage rates, and those have come down already. So, you start seeing this kind of, the market is always forward looking. So if they expect interest rates to go above 5, the market kind of moves past that, which is what we've seen mortgage rates do over the past 6 months. Now they're starting to come back a little bit. And so, we'll see where we really kind of end up here. But it is interesting because there was so much data, like yesterday or Friday, the jobs number came out, and the U.S. was expected to add just over 100,000 jobs for December, and it added over 500,000. So, the job market is still very robust. Now, a lot of those jobs for December are going to be, some of them are going to be seasonal jobs, which means, people just working for a company throughout Christmas. They're not expected to be there for forever. And so there is some kind of look-through effect on that. I would say, when you look at some of the company earnings that we had this past week, we had the big companies. We had Amazon, we had Google, we had Apple, we had StarBucks, and so a lot of the big tech companies, which really used to power the market. I think it's kind of nice. I believe they're starting to get less power over the market, which is a good thing going forward. But you look at some of these companies, and a lot of them moved way up into their quarter, meaning that the stock moved as before they actually reported on the expectation that they were going to have a good quarter. And so, you look at how much these stocks have already moved. Amazon started the year somewhere around $82 a share, I think, maybe 85. This past week, it hit 110, 112 already. And so it should be noted that there is a lot of stocks that have already come back a long way as we start the year here. And just to give you some perspective, the S&P 500, which is the 500 largest companies, most profitable companies, we're off to our best start since 1976. So not wanting to curse the market, but the market is off to its best start since 1976, which is a pretty amazing deal when you look and see how much the NASDAQ already being up 11%. And so you have to remember that the market is always forward looking. And so even though, the coast isn't clear, the clouds haven't cleared, analysts and market investors are always looking past that. So they're saying, okay, maybe this is going to be the worst it's going to be. In 6 months from now, the Fed rates will be over. We'll be able to really start to see what companies are going to be able to do. We'll see what the drag on the economy is, and we'll have more information. So, for what that's worth, that's why I think, one of the big questions I get from people is like, well, why is the stock market going up if things aren't looking that well? And that's normally why every time we do this, we have a big, bear market or whatever, the market bottoms way before the economy does. So it's something you always have to keep in mind. Okay, so you start looking at some of these numbers. I talked about Amazon, looking at Amazon's numbers, pretty impressive as far as the number of, the amount of revenue that they had for the quarter. Amazon had $149 billion worth of revenue for the quarter. So, moving $149 billion worth of goods. Remember, revenue is sales. That's a pretty tremendous number. Now, the stock came down a little bit, even though it had been way up. It came down on Friday. And really because of light guidance, them saying, how are we thinking the next 3 months are going to go? And so, Amazon has a history of doing pretty light guidance. But one of the things you have to remember, yes, we're looking at company quarters, but there is a huge interest in what does this look like going forward? What do you think your numbers are going to be going forward over the next 3 months? And, you can't always get that. So when a company reports their numbers, the first thing you're going to see, whether you're watching CNBC or whatever, is they're just going to tell you what were our revenue, what was our expenses, what's our net income, how much money did we make? But there's no context to these numbers, right? And so afterwards, they will do a conference call where you actually get to hear from the CFO, Chief Financial Officer. Sometimes the CEO will be on there. And like this time, Andy Jassy with Amazon was actually on the call taking questions, which was pretty neat. So when you listen to the conference calls, you get context. So sometimes when you're watching the stocks, or let's say you're watching the stocks after hours, they report their numbers and all of a sudden the stock goes down. And then after the conference call, the stock will go up. Well, that's normally because there's some context there on, is this going to last? How does the next 3 months look? And you can have the reverse of that happen as well, where, they report earnings, the market goes up, and then in their conference call, they come down. So I know this is more of a kind of granular episode for kind of the finance nerds out there, but it is important to kind of understand how these earnings reports impact the markets, because it happens every 3 months. There's a lot riding on this, and there's a lot riding on it just from stock market sentiment, which is, how do people feel about what the market's going to do going forward, and are the numbers going to look okay, and that sort of thing. So Starbucks had a good quarter as well, even though the street doesn't think so. When you actually look at their quarter, the drop came because China wasn't open, and that's where a lot of their stores are. And so they're opening a new store in China every 9 hours. It's pretty tremendous. And I think one of the other crazy things about Starbucks' quarter is that there were $3.3 billion worth of gift cards sold in the last 3 months at Starbucks, which I believe I read. I can't quote the source on this, but that was like more than all the other gift cards combined, right? So $3.3 billion worth of gift cards at Starbucks, which is cash that comes to them right away. And yes, they have to redeem it later on or whatnot. But even even still, like think about, geez, how many of those gift cards will never be used? Or if you just left a quarter on all of them at the very end, how much the money that is. I mean, it's just a tremendous amount. And so now you see the kind of the memes and stuff talking about Starbucks and, the bank of Starbucks, and just the amount of money that they get through their gift card program is just tremendous, because they can use that money up front, and then, you redeem it for your drinks and food later on. So the one company I really want to touch base on today, and the one I'm going to focus on for this episode, being called Future Value, is Apple. And so, we look at Apple's quarter, and initially the stock market sold off based on Apple's quarter. Apple's currently trading for $154.50 a share. But when they reported their earnings, they went down to, I think they were $150 before they reported their earnings. Yeah, they were $150 before they reported their earnings. And then after hours, they dropped almost as low as $144. And so it wasn't a big surprise. They kind of missed on their earnings, which when I give you the numbers here, it's just kind of always makes me laugh. So Apple sold $117 billion for the quarter, and they were supposed to sell $123 billion. And so it was their first quote unquote miss, I think, since like 2016. But it wasn't a surprise, because we knew that in October that a lot of the China factories were shut down. They weren't able to get the iPhones they expected. And so there were a couple weeks there where they really weren't able to make the sales that like they thought they were going to be able to make. And so that really wasn't a surprise. Now it's kind of like looking at the guidance over the next, 3 months, and how does that look? So fast forward a little bit, you go to the Apple earnings call, and one of the huge things that really turned Apple around is the fact that on the earnings call, Apple came out and said, okay, we now have 2 billion iPhones in circulation. 2 billion. We just passed 8 billion on the planet. So 25% of the world's population has an iPhone in their pocket. And so you look at their service revenue, which crossed above 20 billion for the quarter. And that is, if you buy something from the App Store, if you subscribe to Apple Music, if you subscribe to their magazine subscription or whatever, like Apple TV, all those things, all the services that Apple offers, or any money that you spend on other apps, Apple gets a percentage of that revenue. This is where the Epic Games and Apple lawsuit come into play here. But they get a tremendous amount of, income from services. And with 2 billion phones now out and about, walking the planet, so to speak, I mean, that is a tremendous amount of future income to the company. And so when that number came out and all the analysts start, plugging the numbers on this, you start thinking to yourself, what is that customer base going to be worth in the future? And so that's my conversation with you today, is that, when it comes to investing, the number one thing you have to ask yourself is, how does this company make money? What are the different ways in which they can make money? And do you think that income stream is going to be sustainable for them, for the future? So if we were to talk about, Coca-Cola, Pepsi, Starbucks, humans on this planet, as long as they have to drink something and you have to, eat something to stay alive, Coca-Colas of the world, Pepsi's, it's real easy to understand how they're going to make money. Now, obviously, they don't make as much money as an Apple, but still a very sustainable business. And so when you start to look at companies that you want to invest in, you really have to start thinking about, how does this company make money, and is it sustainable? And then how can I put some numbers to it, right? How can I put some numbers to what I'm looking at, and to have some kind of, ballpark figure for what this company is going to be worth in the future. And so one of the interesting things about Apple is the fact that not only have they done a great job of growing their earnings, but they've also done a great job of being able to buy back their own shares. And so we'll discuss that. They pay a dividend, and they pay a dividend and they buy back shares. So they're basically rewarding you as a shareholder in two different ways. And so one of the things that I've always done that has made it much easier for me and been a very good way of looking at what the future value of a company is just to look at what their earnings growth has been over the previous number of years. And so it takes a little bit of hunting to do this, but I went back and looked at Apple's earnings per share, right? Earnings per share is how much is the company making? And it's a great judge. It's where you see the income, all the expenses flow through. What is the net income to the company? And what are the earnings per share for this company that I'm invested in? So if you go back and you look at Apple back in 2013, their earnings were $1.43 a share. And today, last year, they earned $6.15 a share. So in 2013, they made $1.43. 2022, they made $6.15. If you look at the growth rate on that over a 9-year period, that is 17.5%. It's actually 17.59% that Apple has been able to grow their earnings over the last 9 years. And so if we're looking at future value here, future earnings, we can take that and we can look at, okay, if I take the $6.15 they earned last year and I put a $17.5% growth rate on that over the next 10 years, what's that number going to be? Well, that number would be $26.43. Now, there's kind of some danger in that. I mean, I'm assuming they're going to be able to grow at the same pace. There's no guarantee that they're going to be able to grow at the same pace. I realize that, but it's a starting point. And so if I take that earnings, right? If I take those earnings at $26 and I times it by their average PE ratio, I told you I was going to get nerdy today. So the PE ratio is price over earnings index. But if you take the earnings of the company, you times it by the PE ratio, you get the you get the share price. So if Apple was able to grow their earnings at 17.5% over the next 9 years, if they're still trading at a PE ratio of 24, that would mean that Apple's share price would be around $634. Now, there's a couple things this doesn't account for. It doesn't account for dividends and reinvesting those, but that's what the share price would basically they'd be somewhere around $634 a share. So I look at that and go, okay, I'm going to spend $154. I'm going to invest $154 today, and it's going to grow to $634 over the next 9 years. Do I think that's a good deal? And I start comparing that to other companies. Now, like I said, there's no guarantee they're going to be able to grow their earnings at that rate. So one of the things I can do is I can start kind of, moving these numbers around, and I can say, okay, let's say they don't grow at 17.5%. Let's say they grow at 10%. Well, at 10%, those earnings would grow to $14.50. I times that by the PE ratio, and which is 24, and I would get $348 a share is what Apple's share price would be around 9 years from now. Still doubling, more than doubling my investment over the next, 9 years. And so, you can look at this. Maybe they're not trading at the same PE ratio. Maybe the PE ratio is lower, but you can start to kind of move these around and see where you might be. And so it's more important to be able to do these steps than it is kind of the number that you're coming out with. And then obviously, when you look at a company, how steady are their earnings? Well, when you look at Apple's earnings over the last 9 years, they pretty much stair-step up, which is a lot different than maybe a company that has great earnings one year, terrible earnings the next, and really kind of ping-pongs around. So, you have to take that into consideration as well as, what's the right reliability of the earnings of the company I'm looking at. And so for somebody like Coca-Cola, Hershey's, those kind of companies, it's going to be pretty steady. And really, some of your investments, you want them to be that way. Apple has become pretty steady. If we're looking at oil companies, for instance, there's probably going to be 2 to 3 years there in a 10-year period of time where oil is going to drop and they're not going to do well. So, there's different factors that you have to consider. And obviously this gets a lot more granular kind of the deeper you go. But just from a eyeball perspective, these are kind of the things that you want to look at. And so every couple of years, you'll get something like, let's call it a fad. Let's call it maybe the next change. And so, years ago, it would have been 3D printers where all of a sudden you think they're going to have these gigantic earnings in the future. And so the stock prices go up. Everybody's going to have a 3D printer on their desktop, just like a computer. All of a sudden that doesn't work out. The stocks come way back down again, right? Same thing with the crypto implosion that we had. And then right now, which, maybe AI. So you look at the AI stocks that are out there. One of the most well-known ones right now that's actually tradable, the OpenAI, ChatGPT that's gotten so much press. It's not public yet, but there is one public company. The symbol is just AI, and look at what that's done over the last month, right? So now everybody's looking at all the different uses that's going to be able to have, and so they start to extrapolate what those earnings could look like in the future. And that's why you get these huge run-ups in stocks. And then if it works out, maybe it does, maybe it doesn't. You look at some of the stocks that we've had over the last couple of years with the pandemic and this massive, this growth extrapolation that we saw on something like maybe a Peloton, and then it didn't work out. All of a sudden the stock comes way back down to earth. So that's the reason that these things happen, is because analysts, investors are looking at what are the future earnings of this company and how do I price the stock based on those future earnings. And so with interest rates, the higher interest rates go, it makes those earnings in the future worth less today because of the time value of money. So I'm really kind of getting out there right now. But I hope this is helpful for you because, as you start looking at companies that you want to invest in, this is going to be an important thing for you to be able to do. Of course, if you don't like this, you can always ask for somebody's help, ask an advisor to help you do that, or you can just, put your money into an S&P 500 index fund and be like, okay, I'm just going to make sure I do this consistently. And that's really, obviously, if you listen to any of these podcasts at all, that is the main thing, right? Consistency is the key to improving your financial future. And we discussed a lot this summer, me discussing buying shares while they're low, investing in companies while they're low. Now you have that we've had this nice kind of recovery here, short-term recovery from October to today. And now you have investors saying, well, geez, I wish I would have put more money into this stock. I wish I would have invested in this stock. Now the thing's already gone up so much, I don't know if I want to do that. Well, if you're looking at a chart over 6-month period of time, it might look like that. But if you look at it over a 5-year period of time and see how far some of these stocks really did drop, you might not feel that way. So you shouldn't be investing based on what the chart looks like anyways. You should be looking at, okay, is this a company I want to be invested in for the long term? Do I want to be a partner with this business? Do I want to be a part owner of this business and share in their future cash flow, not just for the next year, but the next 5 years, 10 years, 20 years? And if you do that, you'll make better decisions. So even though this was a more granular episode, I hope you found that helpful, and appreciate you as always. Have a great week. Don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.